All right, so chapter 15. Uh, Technically, the most important chapter of the whole class, I would say, because this is what people get paid to do in investment management, okay? Financial statement analysis, where you take your knowledge of accounting, which means that you can understand a financial statement because that financial statement is composed using the rules of accounting that we've been learning, using your knowledge of business of whatever industry this company is in that you're analyzing, combining all that together to understand what's happening in the business. Okay. And making a decision based on that. Usually it's an investment decision, some management decision, but it's to inform decision making. Okay. And so you need to know a lot to be able to do this well. You need to, of course, know the rules of accounting really well. You also need to understand business, okay? Because the financial statements are not the totality of the business, right? It's like there's a lot of things that are happening in the world that are not captured in the company's financial statements. So it's an art too. Okay, there's a technical factor of knowing accounting of in understanding the financial statements, but you there's a lot of judgment, there's a lot of business knowledge, general business knowledge that you have to do this really well. Okay, not many people do it really well. That's why it's hard. It's really hard to beat an index uh, stock investment fund. Okay, even though there's people making a lot, many people, thousands of people employed in trying to do this well, it's very difficult to beat just the general broad consensus view uh, more often than not. Okay. Um, but we're going to learn, because it's like even if you have a small business or whatever, there's some level of financial statement analysis that you should be comfortable with. Okay. So we'll explain how financial statements are used to analyze a business. Um, Horizontal and vertical analysis are ways that you can basically take the raw data from the financial statements and convert it into a more interpretable form. Okay, so we'll talk about these two, and then the ratios. Okay, so we've been covering a lot of these. We've done quite a few. We're gonna now re-summarize them. They're kind of you can categorize them into certain buckets of like what information or what theme they are. So we'll just recap these ratios and organize them into themes. And you can then you'll be asked, of course, in your homework and stuff to calculate the ratios and kind of give some interpretation. So really calculating the ratios, just the technical ability to do that is not so hard. It's interpreting them, contextualizing them. That's the hard part. And that takes, a lifetime of practice and understanding business and experience. Okay. But, at the beginning, it's just calculating the ratios and having a basic understanding of what they are. Uh, for this class, I think that's pretty good. Okay. So we'll just kind of start with that. Financial statement analysis. Why are we doing this? Um, well, it's to help us form some analysis for decision making. Okay, so uh, what are the types of analysis we can do? The first is we can compare one company to itself over time. Okay, so if you had multiple years of financial statements, you could see how the company is doing over time, what is changing. Okay, um, and you saw a lot of the financial statements from companies that we've been looking at. They usually present at least 2 years. Okay, sometimes more, sometimes 3 or 4. But that is to facilitate this exercise of comparing the company to itself over time. You can also use financial statements to compare one company with a competitor. Okay, so if you have two different companies, you can perform an analysis to see how the company you care about stacks up against a particular competitor. Okay, so maybe if you're looking at retail companies, you look at Walmart versus Target, okay, or TJ Maxx versus Ross, right? These are examples of two companies that are like distinct industry leaders. These are like large big box retailers like Target and Walmart are the two biggest, right? Uh, Discount clothing retailers, TJ Maxx and Ross. So sometimes there's a natural single competitor that is worth looking at. Sometimes it's worth it to compare your company against the industry average, right? So if you're looking at like a steel maker, okay, maybe there's not just one competitor. You want to see how does your steel company, steel manufacturer compare to the other industry, like the industry as a whole, right? How much are their margins competitive, etc. Okay, so uh, again, this is using this term benchmark, okay? So you compare your company with some industry benchmark, and this is a very common practice because you want to make sure your company is not below average, right? You want to be at least average on the things that are important. And if you're below average, this is a cause of concern. Um, you're not maximizing the potential of the company, at least compared to your peers. This is, people are talking about consulting companies going out of business because of AI. One of their key functions, and when I say consulting companies, does anyone know what are some of the big consulting firms out there? Management consulting. Does anyone know what they're called? Okay, McKinsey, Boston Consulting Group, Deloitte. These companies, these are companies that have management consulting or like technology consulting, but really McKinsey, Bain, I guess the big three for management consulting are McKinsey, Bain, and BCG as it's called, but that stands for Boston Consulting Group. So these companies have people that work for them that go and advise corporations, usually large businesses, on how they can improve their operations. And so a lot of what they do, yes, it's true, is you know put together PowerPoint presentations, frame corporate decision making in certain ways to like make it more understandable. But one of the big value adds that they have is that since they work with so many companies, they have lots of benchmark data. Okay, so a lot of times a business does not have ready access to their competitors' financial information, more than just the high end, right? Or like the publicly disclosed. So what the management consulting companies do is that they have data on competitors, and though they won't explicitly say that this competitor does this, a company can hire them and get some sense of how they stack up against competitors. And that data is not, AI doesn't know that data either because it's not really publicly available. Okay, so this is a big niche that these management consulting firms fill, is the ability for companies to benchmark themselves. But yeah, this is very important. This is, this benchmarking of your company against in industry is like a very important thing to see how you're doing as a business. Okay. Any questions on this? Pretty straightforward. I think maybe seeing it in a framework is more, this is kind of what management consultants do. They'll take something that kind of everyone knows about, but put it into a very uh, uh, structured format. So this is what I'm trying to do here with why we do business analysis.